And I always say, reality always wins, but not on day one. How they do that synthetically, again, to apply to capital markets. Because capital markets are a complex dynamic system. So we've had 60 or 70 years. I mean, complex systems have been around since the Big Bang. That was one of them, so 13 billion years. But we've had, really since 1960, it developed as a science, and partly because we need the computing power. And it works really well in so many fields. And then one of the things I said was, why couldn't it work in capital markets? And the minute I said that and started looking at it, it was like, oh, this actually describes what's going on. It's not a bell curve, it's a power curve. It's not an equilibrium method, it's a very inefficient method. I once looked at the list of all the Nobel Prize winners in economics, and I estimated about a third of them were for things that are just wrong, like empirically wrong.
Yeah, it's
like Eugene Fama, efficient markets. Markets aren't efficient. Why did the stock market fall 22% in one day on October 19th, 1987? What's efficient about that? But there are these other tools that you can use. So I've had meetings in Los Alamos. I said, we could crack the code here. We get some physicists, applied mathematicians, psychologists, an economist, a lawyer, maybe an artist. Who knows? Get an eclectic, real diversity, not the other kind of fake diversity, and just work as a team science, and crack the code in capital markets. We love that. What a great idea. Let's put that in some kind of proposal. Let's get some funding. Let's do it. I talk to PhD economists. They say, you have nothing to teach us. Would you want to join this team? Why would I want to team up with a physicist or Matt? We have it all figured out. So okay, so the impediment to improvements in economics are the economists themselves, because they don't know what they're missing. Inflation can come from two major vectors. One is the supply side, which is called cost push inflation. Costs go up and it gets pushed onto the market and the consumer. The other one is demand pull inflation, which is more psychological. It's driven by consumers. It's like, thinking of buying a new refrigerator. What's the rush? Oh, the price is going up. Well, I better go buy it now, because if I wait 6 months, it's going to be 20% more. Now, when you look at the 70s, and I lived through it, that started out with supply shocks from the Arab oil embargo after the Arab-Israeli war in 1973. The price of oil quadrupled in 1974. Now it went from 3 to 12. Sounds, small change compared to today, but it did go up by a factor of 4 in 6 months. So that was a shock, and then that spread. But it actually, I remember early in the Ford administration, Gerald Ford now in Greenspan, they had these buttons that said WIN, which stood for Whip Inflation Now. It was a big PR campaign. Whip Inflation Now. We were in one of our worst recessions since World War II within 3 months. Stock market fell, I think, 30 or 40%. I was just out of college. But
deflation.
Yeah. I was just out of college, but I said, I'm gonna go to graduate school, I think. But all my friends went to Wall Street, and they were like, I'm a Wall Streeter, making all this, and they were all unemployed within 6 months. We were commiserating. But the point is that proto-inflation turned into disinflation and recession and a stock market crash very quickly. But then it came back again thanks to our friends Arthur Burns and G. William Miller. G. William Miller, not well remembered, but probably the worst Fed chairman ever, although that's a major claim. And then they just pumped the money supply, and then it did take off on the demand side. So by the late 1970s, by then I'd actually started working for a living. I was at Citibank. I was the International Tax Council. They used to just give you a raise. You didn't even have to ask. They would say, hey, here's another $20,000. That's back when $20,000 was real money. Yeah. And they would just give you a raise because they were afraid you were going to quit. They say, well, thank you. And then they give you another one a few months later. That was out of control. And that's when gold went from $35 to $800, a 2,100% increase. Now let's come to today. The inflation is coming from the supply side. It is coming from the supply chain breakdown. The pandemic made it worse. The war in Ukraine made it worse. It's not where it started. I was actually able to trace the roots of this. It started with the Trump tariffs on China in 2018. Now, I don't want to debate tariff policy. I actually happen to think that was a good idea. But what happened next was, so Trump throws the tariffs on refrigerators and appliances and the solar modules. Well, it was applied to everybody, but China made most of it. So it was really aimed at China. So China shoots back. The two largest soybean producers in the world are the United States and Brazil. The biggest consumer is China. They need the protein. they were buying all their soybeans from the United States because we were buying all the stuff from them. Like, well, what can we buy from the United States to balance the deficit a little bit? They will buy the soybeans. And they did. Well, after Trump throws the tariffs on, China sends all the orders to Brazil. That's not a phone call. I mean, you got vessels at sea, you got port logistics, you got farmers who got to increase their capacity, you got to build new facilities in Brazil, and everyone involved, nobody wants a 6-month deal. They want a 5-year deal or a 3-year deal at least. So all that soybean production is now expanding in Brazil. All the Brazilian soybeans are, not all of them, but a lot of them are going to China, and that's locked in. That's not coming back to the United States anytime soon. So what do the U.S. soybean growers do? Well, they looked around. Hey, the Netherlands, they need soybeans. So we start selling to the Netherlands. But think about what you're doing to transportation lanes. You're scrambling them. Yeah. You say, okay, you're not going out of Port of LA. You're going out of Houston or Port of Savannah or Port Elizabeth. And, Brazil, you get better fix things up in Rio or wherever they were coming out of, Buenos Aires maybe, to get those to China, and can you go through the Panama Canal or not? But this was a major reshuffling. And it was the beginning, and then the tariffs went back and forth. They escalated to $500 billion on each side. But this really broke the supply chain. And then the pandemic made it worse, and the war in Ukraine made it worse. So right now there are 3 narratives going on. There's the narrative, there's what Jay Powell thinks. Yeah. And we know what he thinks. I always say forecasting the Fed is the easiest thing I do because they tell you what they're going to do. You just have to listen and believe them. So I don't need to recite it, but it's, he's going to 50 basis points in December, probably 50 basis points on February 1st, maybe 25 basis points on March 22nd. They're going to keep raising rates. They're going to look for the terminal rate. I don't know what it is because Jay Powell doesn't know what it is. No one knows what it is. But it's the Potter-Stewart approach. They'll know it when they see it. So Powell is determined to get there. In my view, he's already past the terminal rate. We're at the terminal rate. And because recession's coming off the top, it's not going to be 2%, next month or anything, but it's coming off the top. So then this brings us to the Wall Street narrative, which is, inflation's off the top, economy's slowing down, Powell's going to pivot. This is the pivot narrative. Probably cut rates by, March or April. And if they're cutting rates, buy tech stocks, so it's like, buy NASDAQ, So that's the Goldilocks soft landing. Yeah. And I can't believe Powell actually said soft landing at the Brookings, but whatever. Maybe he's feeling good that day. Then there's my version. He's going to raise. He's already been raising rates into economic weakness. Now he's going to raise them into recession. I'm a critic of Milton Friedman in some way. He was a great humanitarian. As an economist, I have a few criticisms. One thing he got right, that everyone agrees on, is that monetary policy acts with a lag, and a certain lag. Well, I'm sorry, you started raising rates in March. The policy rate on March 1st was 0. Now it's 4.25. It's going to be 4.75 in a couple 10 days or less. And to go from 0 to 4.75 in 8 months, 9 months, that's more than Volcker did. He eventually got much higher, but Powell is determined to avoid this mistake, what I call the Volcker mistake, and he's going to keep raising. Now they will pivot, but it'll be too late. It'll be after the damage is done.